New York City, May 17, 2019. The Nasdaq trading floor is ringing with applause and the popping of champagne corks. A massive blue banner hangs above the podium. Luckin Coffee, trading under the ticker symbol LK, has just achieved a staggering $12 billion valuation, promising investors that it will completely crush Starbucks in mainland China. Institutional fund managers are salivating over the massive consumer class, desperately buying into the hypergrowth narrative. But half a world away, inside the humid, glass-walled corporate headquarters in Xiamen, the foundation of this supposedly revolutionary coffee empire is completely imaginary. There are no massive lines out the door. The explosive profit margins are an absolute fiction. And over the next year, top executives will literally buy their own product, using shell companies to fake over $300 million in revenue. If you want to understand how modern financial empires are built on vapor, and how to spot the cracks before the market crashes, hit subscribe and join the few who actually read the balance sheets. The Luckin Coffee illusion is not a story about caffeine. It is a story about the devastating power of aggressive unit economics, zero interest rate greed, and a massive loophole in cross-border auditing that tricked Wall Street. Venture capital operates on a very specific, predictable set of expectations. In 2017, the pitch meetings in Beijing and Silicon Valley were almost identical. The Luckin founder sits across from the venture capital fund manager in a high-rise office. The fund manager says, "The Chinese market historically drinks tea. How do you plan to beat 20 years of entrenched Starbucks brand loyalty?" The founder replies, "We do not beat them at coffee. We beat them at software. We are not a traditional beverage company. We are a pure technology platform. There are 0 physical cash registers in our retail stores. You cannot pay a barista with a physical banknote. Every single customer must download our proprietary mobile app to place an order." This specific dialogue changed the entire mathematical valuation model. By framing a low-margin retail product as a high-margin, high-growth technology ecosystem, Luckin bypassed traditional restaurant analytics and accessed massive pools of Silicon Valley capital. They were selling a narrative that global investors were desperate to buy. The promise of the massive Chinese consumer market combined with the infinite scalability of a software application. The money flooded into their bank accounts, and the aggressive mandate was simple: grow the physical store count faster than any company in modern history. To achieve this impossible hypergrowth, Luckin relied on a financial mechanism called blitz scaling. Instead of building massive, comfortable lounge spaces like their competitors, they built tiny pickup kiosks in office building lobbies and university campuses. This meant exceptionally low overhead and rapid deployment. But the real weapon was extreme customer acquisition subsidies. When a user downloads the application, their first cup of coffee is entirely free. When they refer a friend, they receive another free cup. The marketing team flooded social media platforms with aggressive buy 2 get 1 free digital vouchers. In traditional retail economics, the customer acquisition cost must eventually be eclipsed by the lifetime value of that customer. The business takes a heavy financial loss on the first visit, assuming the customer returns and pays full retail price for the next 20 visits. Luckin was burning cash at a horrifying rate, subsidizing up to 90% of every single transaction. Growth investors completely ignored the massive operating losses and cheered the only metric that mattered to them, which was active user growth. By late 2019, Luckin had opened over 4,500 physical locations, officially surpassing the Starbucks footprint in China. The user acquisition chart looked like an absolute rocket ship. But mathematics is entirely unforgiving. Behind closed doors, the executive team was staring at a fatal structural flaw in their business model. The Chinese consumer was absolutely thrilled to drink Luckin coffee when it cost 50 cents. But the moment the algorithms reduced the subsidies and asked the customer to pay the full price of $3, retail sales instantly cratered. The entire $12 billion valuation was based on the strict projection that profit margins would turn positive as customers were slowly weaned off the massive discounts. The physical reality was the exact opposite. Wall Street analysts were expecting a massive revenue jump for the upcoming third-quarter earnings report. If Luckin reported a sudden stall in active user spending, the stock would collapse, and their cheap access to capital would vanish overnight. The company was completely trapped in its own hypergrowth narrative. The millions of retail customers simply refused to buy the coffee at full retail price. Facing a catastrophic collapse in share price, the executives made a chilling operational decision. If the public would not buy the coffee at the required margin, the company would simply manufacture the demand and buy the coffee from themselves. The greatest accounting illusion of the decade was about to begin. Xiamen, China, late summer 2019. The air conditioning hums intensely inside the glass-walled executive suites. On the glowing monitors, internal tracking dashboards display the bleak reality of the daily retail sales. The gap between what Wall Street expects and what the kiosks are actually selling is widening by the hour. The chief operating officer and his tight circle of loyal lieutenants pull up entirely new, isolated spreadsheets, completely disconnected from the main audited accounting software. These are not standard operational documents. They are the architectural blueprints for a parallel financial universe. The executives realize that manipulating the numbers by a few minor percentage points will not save the stock price. They need hundreds of millions of dollars to magically appear on the income statement before the end of the fiscal year. The fraud they are about to initiate is not a complex Wall Street derivative. It is not an opaque off-balance sheet debt vehicle used by banks. It is shockingly analog in its fundamental design. It relies on a highly weaponized version of corporate gift cards, turning the exact same proprietary technology that made them a darling of the Nasdaq exchange into an unstoppable engine of absolute financial deception. The shadow network is ready. The plan requires an external buyer to absorb the massive fake volume. In a quiet, unrecorded meeting, the specific architecture is laid out. The lead executive says, "We cannot simply fake individual retail user accounts. The auditors will eventually see the empty digital wallets and the lack of credit card data." The junior lieutenant asks, "So who exactly buys the fake volume to make the numbers match?" The executive answers, "Corporate clients, massive bulk purchases. We create the companies ourselves, and those shell companies buy 50,000 coffee vouchers at full price in a single transaction." This is the shell game. In the legitimate corporate world, businesses frequently buy bulk gift cards to give to their employees as tax-deductible perks. Luckin exploits this completely normal business practice. By funneling the fake revenue through massive, faceless corporate orders, they completely bypass the need to show organic, individual user engagement. A single fake corporate buyer can account for $5 million of recognized revenue in a single afternoon. No physical cups of coffee ever need to be brewed. No milk is poured, no paper bags are printed. It is just a digital tally on a server, instantly recognized by the internal accounting system as high-margin revenue. Executing this illusion requires a sprawling, highly coordinated network of shadow entities. Investigative journalists would later uncover dozens of these shell companies registered across various Chinese provinces. On paper, they appeared as entirely independent technology firms, regional logistics providers, or local marketing agencies. In reality, they were tied directly to Luckin's chairman and his close associates. They shared the exact same corporate registration addresses. They shared identical email servers. They featured rotating board members drawn directly from the chairman's previous corporate ventures in the ride-hailing and rental car industries. These shadow entities began generating massive purchase orders for hundreds of thousands of digital coffee vouchers. Because Luckin's entire system was built on closed, proprietary software with zero physical cash registers, injecting these massive orders into the main database was incredibly easy. The internal system logged the fake sales seamlessly. The average selling price metric immediately began to rise. The gross margins magically flipped from heavily negative to highly positive. By the fourth quarter of 2019, these phantom bulk corporate orders represented a massive percentage of the total revenue reported to the public. The software was effectively laundering the fake numbers into legitimate-looking corporate growth metrics. The corporate income statement looked absolutely flawless. Wall Street analysts aggressively upgraded the stock, mesmerized by the sudden path to profitability. But creating fake revenue creates a massive ticking time bomb on the balance sheet. In double entry accounting, every single entry has a dual nature. If a shell company signs a contract to buy $10 million worth of digital coffee vouchers, that $10 million eventually has to show up in Luckin's actual corporate bank accounts. You cannot pay real dividends or satisfy real creditors with imaginary digital money. Ernst & Young, the independent corporate auditor, was scheduled to review the annual financials. If they looked at the corporate cash reserves and saw a $300 million hole where the corporate bulk payments were supposed to be, the entire scheme would unravel instantly. The executives had successfully faked the digital sales, but now they faced a much more dangerous physical problem. They had to find a way to put real, physical cash into the bank accounts of the shadow companies, just so those shadow companies could wire the money right back to Luckin. They needed to launder their own money to hide the lies. Beijing Financial District, Autumn, 2019. Millions of dollars of real corporate currency are quietly moving through the opaque shadow banking system. The Luckin executives are staring at the massive pile of cash they raised during their $561 million initial public offering. This IPO money was supposed to be strictly used for opening new retail locations and acquiring real customers. Instead, it is being illegally weaponized to wash the fake revenue. The operational pressure is suffocating. Every single day the fake corporate voucher sales tick up, the corresponding cash deficit on the balance sheet grows larger. The fraud has now reached a scale where it requires constant, active daily management. Dedicated teams of accomplices are managing dozens of different bank accounts across different provinces, logging in via secure cryptographic tokens to authorize massive outbound wire transfers. They are orchestrating one of the largest and fastest corporate money laundering operations in modern retail history, all while the marketing department issues breathless press releases about the explosive growth of their new retail coffee model. The executives are physically draining the company's real cash reserves to maintain the hallucination of an infinitely scaling technology empire. To move the IPO cash out of Luckin and into the shell companies without triggering alarms, the executives invent massive fake expenses. They call a trusted, complicit raw material supplier. The Luckin executive says, "We need you to officially invoice us for $10 million of raw coffee beans that we did not actually order." The supplier, looking at the massive sum, asks, "What exactly do I do with the money when you pay the invoice?" The executive answers, "You keep a small percentage fee for your trouble, and you immediately wire the rest of the cash to this specific third-party logistics firm." That third-party logistics firm is, of course, one of the shell companies. This specific dialogue illustrates the classic accounting trick known as the round-tripping of cash. You cannot just hand company treasury money directly to your own shadow entity. You have to create a dense paper trail that looks exactly like legitimate operational spending. So Luckin starts recording massive, fictitious payments to supposed human resources agencies for outsourced labor, and to vendor networks for milk and paper cups. The real cash leaves the front door fully disguised as a legitimate, audited operating expense. Round-tripping is the mechanical heartbeat of this entire financial fraud. Step 1. Luckin uses actual shareholder cash to pay a fake, highly inflated invoice to a friendly middleman. The accounting system naturally records this outflow as an operating expense. Step 2. The middleman transfers that exact cash to the shadow corporate entities secretly controlled by the chairman's associates. Step 3. those shadow entities use that exact same cash to pay Luckin for the massive bulk orders of digital coffee vouchers. The cash arrives right back at Luckin headquarters. The accounting system records this inbound wire as top-line retail revenue. The money has travelled in a complete invisible circle. The brilliant, sinister beauty of this mechanism is that the actual cash balance at the end of the month perfectly matches the auditor's expectations. The bank statements are entirely real. The cash is actually sitting in the account. It is just the exact same money recycled over and over again, simultaneously inflating both the expenses and the revenue. They artificially inflated their supply chain costs strictly to hide the devastating fact that they were secretly buying their own product to fool Wall Street. The algorithm of deception was running flawlessly. In the third quarter of 2019, Luckin reported a net revenue increase of over 500% compared to the previous year. The stock immediately skyrocketed past $50 a share. The executive team was hailed as retail visionaries on global financial networks. The shadow entities were quietly washing the cash in the background. Ernst & Young had not yet flagged the sophisticated round-tripping manoeuvres. It seemed like the absolute perfect corporate crime, executed with a mathematical precision that Wall Street analysts completely failed to detect. But financial markets have an aggressive immune system. Short sellers. These are cynical investors who spend their entire lives looking for anomalies in the math, betting heavily against fraudulent companies. In early January 2020, an encrypted email arrived in the inbox of Carson Block, the notoriously aggressive founder of Muddy Waters Research. Attached to the email was a highly detailed, anonymous 89-page document. It did not contain complex theoretical derivative models. It contained something far more dangerous to the company. It contained the raw, physical proof that the digital numbers on the NASDAQ were a complete hallucination. San Francisco, January 2020. The cold glow of the monitor illuminates the dark office at Muddy Waters Research. Carson Block is slowly scrolling through the anonymous 89-page PDF. The document is incredibly dense, compiled by a hidden consortium of hedge funds with deep, ground-level intelligence networks operating in mainland China. It makes a staggering, multi-billion-dollar accusation. Luckin Coffee is artificially inflating its retail revenue by over 80%. But what makes the hair on the back of the analyst's neck stand up is not the financial accusation itself. It is the sheer brutality of the methodology. The anonymous authors had not relied on regulatory filings or abstract market data feeds. They had executed the most labour-intensive corporate espionage operation in recent financial history. They recognised a fundamental truth about retail fraud. If a company claims to be selling 500 cups of coffee a day in a specific building lobby, there is only one foolproof way to verify the math. You have to physically walk to the store, sit down in a chair, and manually count the paper cups as they leave the counter. The sting operation was already complete. The logistics of the espionage operation required absolute, uncompromising military precision. In a secure staging room in Beijing, the ground team lead is briefing the newly hired recruits. The lead investigator says, "You will walk into the targeted coffee kiosk exactly at opening time. You will find a discreet seat with a perfectly clear view of the pickup counter. You will press record on your smartphone, and you will not move from that spot for 12 straight hours." A young recruit asks, "What if the phone battery dies halfway through the shift?" The lead replies, "You bring multiple backup battery banks. We need continuous, completely uninterrupted footage. Every single brown paper bag, every single plastic cup that crosses that counter must be permanently captured on video." Over 1,500 individuals were quietly hired for this massive operation. 92 full-time staff and over 1,400 part-timers. They aggressively targeted 981 specific store locations across 53 different Chinese cities. From the bustling financial districts of Shanghai to remote, quiet Tier 3 cities. They were building a massive, undeniable physical ledger to combat the fabricated digital ledger presented to Wall Street. The investigators successfully recorded 11,260 hours of surveillance footage. A central processing team then manually watched every single minute of the tapes, carefully counting every item handed to a real customer. The video evidence was absolutely damning. The physical stores were ghost towns compared to the explosive financial filings. But the sting operation went one crucial step further to uncover the exact algorithm of deception. Every order placed in the Luckin mobile application generated a digital receipt with a sequential 3-digit pickup number. Customer 1 gets 001. Customer 2 gets 002. The ground spies were instructed to buy a coffee at the very beginning of the day and another coffee at the very end of the day. By mathematically subtracting the first receipt number from the final receipt number, they calculated exactly how many orders the internal software processed. When the analysts cross-referenced the digital receipt numbers with the physical video counts, they found the undeniable smoking gun. The proprietary Luckin application was hard-coded to skip numbers. The technology itself was rigged to deceive any casual observer trying to track the volume of daily sales. During slow periods of the afternoon, the software would automatically jump the sequence. A legitimate customer would receive order number 100. 10 minutes later, the very next physical customer would receive order number 105. 4 phantom orders were instantly and silently injected into the database. The receipts also proved that the rising average selling price was a complete mathematical fiction. Customers were still using massive promotional discounts. On January 31, 2020, Carson Block took to social media and published the anonymous report in full, announcing to the world he was heavily shorting the stock. The trap was finally sprung. But the market reaction was entirely bizarre. Luckin immediately released an indignant, aggressive statement denying everything. Wall Street investment banks, desperate to protect their lucrative underwriting fees, rushed to defend the company. Major financial analysts issued advisory notes calling the short seller report malicious, entirely flawed, and structurally inaccurate. For a few agonizing weeks, the stock price wobbled but ultimately held its ground. The public narrative was actively protecting the fraud. But deep inside the corporate auditing department, a silent, terrifying panic was rapidly spreading among the accountants. Shanghai, February 2020. The glass boardroom at Ernst & Young is suffocatingly tense. The viral public short seller report has completely changed the risk profile of the ongoing Luckin audit. The senior audit partners are staring intently at the massive balance sheet line item for corporate bulk sales. Before the report went public, they might have casually accepted standard internal documentation and signed off. Now, their own professional accounting licenses, their freedom, and the firm's global reputation are directly on the line. The digital numbers on the screen look perfectly balanced, but the overwhelming video evidence published online tells a completely different, horrifying story. The auditors know perfectly well that if they sign off on a fabricated income statement, they will face the direct, unforgiving wrath of the United States Securities and Exchange Commission. They immediately stop looking at the polished digital dashboards provided by management and start demanding the raw, unvarnished financial truth. They need absolute third-party verification. They need to see the actual, original bank statements from the supposed corporate buyers. And they need direct, unmediated contact with the procurement executives of those shadow companies to confirm the sales. The senior audit partner sits across from Luckin's chief financial officer. The partner says, "The internal ledgers are no longer sufficient for our compliance standards. We need direct, independent confirmation of these bulk corporate purchases. Give us the contact information for the procurement officers at these 50 corporate clients immediately. The executive shifts uncomfortably in his leather chair. He replies, "Those clients highly value their corporate privacy. We absolutely cannot disrupt their daily operations for a routine audit check." The partner leans forward, slamming the folder on the table. He says, "It is not a request. If we do not get the underlying bank statements and direct verbal confirmation of the wire transfers by Friday, we refuse to sign the annual report." This intense dialogue is the ultimate breaking point. The round-tripping of cash worked perfectly when the auditors were only looking at the aggregate balances at the end of the month. But the precise moment the auditors demanded to pierce the corporate veil of the shadow buyers, the executives were totally trapped. They began providing obviously forged documents, aggressively delaying meetings, and making wild excuses. The auditors knew they had found the rot. Faced with an absolute revolt from Ernst & Young, the independent directors on Luckin's board had no choice but to act swiftly to protect themselves from criminal liability. They immediately formed a special committee to investigate the claims internally. They hired independent outside counsel and deployed forensic accountants. The mechanism of a true forensic audit is highly aggressive. It is not about trusting the general ledger. It is about seizing the physical hardware. The accountants imaged the hard drives of the top executives without warning. They aggressively parsed through deleted emails, decrypted internal chat logs, and accessed hidden servers. The wall of silence completely shattered. They uncovered the alternate, isolated spreadsheets used to track the fake sales. They traced the exact Internet Protocol addresses used by the finance team to authorize the round-trip wire transfers. They meticulously documented the direct links between the chairman and the shell companies. The evidence of the fabricated database was undeniable. $300 million, nearly half of the company's entire reported revenue for the fiscal year, was completely fake. The board of directors realized the company was structurally insolvent. They had to confess to the market. April 2nd, 2020. Black Thursday. Just minutes before the New York markets open, Luckin Coffee quietly files a Form 6K with the Securities and Exchange Commission. In the dry, highly legalistic language of corporate disclosures, the filing drops an absolute nuclear bomb on Wall Street. The special committee officially announces that the chief operating officer and several employees reporting to him engaged in severe misconduct, including fabricating 2.2 billion Chinese yuan in sales. The filing further admits that the operational costs and expenses were also substantially inflated to hide the fake revenue mechanism. The gig is entirely up. The entire $12 billion hypergrowth narrative is instantly exposed as a massive spreadsheet manipulation. Institutional funds that had aggressively defended the company on television just weeks prior are caught completely blind and entirely exposed. As the opening bell loudly rings on the Nasdaq floor, the algorithmic sell orders begin to pile up at a speed that immediately triggers and breaks the exchange circuit breakers. The brutal financial slaughter of the retail and institutional shareholders is about to begin. New York City, 9:30 in the morning. The trading screens flash violently red. Luckin Coffee's stock price goes into an absolute, terrifying freefall. Trading is forcefully halted 6 separate times in the very first hour due to extreme, uncontrollable volatility. The stock, which had been trading around $26 the day before, plummets to under $5 a share in a matter of minutes. The trading floor is chaotic as high-frequency algorithms and human traders alike aggressively rush for the extremely narrow exits. In a single trading session, nearly $5 billion in market capitalization is completely and permanently vaporized. Retail investors who bought into the Starbucks killer narrative watch their life savings evaporate in real time. The blue banners and champagne of the initial public offering feel like a distant, sick hallucination. the company has officially transformed from the fastest-growing unicorn in Chinese corporate history into a massive international financial pariah. The collapse instantly triggers a geopolitical crisis over cross-border investments, forcing lawmakers to completely re-evaluate the risk of allowing foreign entities to list on American exchanges without absolute, unhindered audit transparency. Inside the corporate boardroom, the executive purge is swift and brutal. The independent committee confronts the founders. The lead corporate lawyer says the Securities and Exchange Commission is already drafting federal fraud charges. You are both terminated immediately, effective today, and you will surrender your internal access. The founder replies defensively, "We built the entire physical network. The stores are real. The customers are real. We just needed more time." The lawyer shakes his head in disgust. He says, "The revenue was fake, the margins were fake, and the equity is now worthless. We are filing Chapter 15 bankruptcy in New York tomorrow to shield the remaining assets from angry creditors." By May, the Chief Executive Officer and the Chief Operating Officer are officially fired. By June, following a vicious, highly public internal power struggle, the chairman is completely ousted. The Nasdaq exchange issues a formal delisting notice. The stock is permanently banished to the over-the-counter pink sheets, a dark graveyard for failed and fraudulent equities. Luckin ultimately agrees to pay a $180 million penalty to the SEC. The fraudulent empire is dismantled. But the story of Luckin Coffee contains a bizarre, highly unusual paradox. In most massive financial frauds, like Enron or Wirecard, the underlying business is completely hollow. Once the fraud is exposed to the light, the company inevitably dissolves into dust. Luckin was entirely different. Beneath the $300 million of fake corporate bulk orders, the physical pickup kiosks actually existed. The mobile application was highly functional and efficiently coded. The localized drinks were genuinely popular with the younger demographic. A new management team, financially backed by private equity, took over the smoking wreckage. They executed a brutal, highly effective turnaround mechanism. They immediately stopped the unsustainable cash burn subsidies. They aggressively closed thousands of underperforming physical locations. Most importantly, they raised the retail price of the coffee to realistic, profitable levels. Stripped of the hyper-growth expectations of a massive public valuation, they operated it like a normal, boring retail business. And shockingly, it actually worked. By 2022, the underlying company achieved its first genuinely profitable quarter. By 2023, they had successfully expanded to over 13,000 verified, highly profitable stores. The operational resurrection of the physical coffee shops does not erase the devastating reality of the financial fraud. Wall Street bought a $12 billion illusion because they were completely blinded by the macro narrative of endless Chinese consumer growth. They ignored the terrible zero-interest rate unit economics, and they ignored the early warnings. But the truly chilling reality is that the structural firewall that allowed this fraud to happen is still largely intact. When a company operates in a jurisdiction that actively blocks foreign regulatory oversight, auditors are fundamentally handicapped. The sprawling shell companies, the aggressive round-tripping of cash, the manipulated proprietary databases. These tools of deception are actively being used right now by dozens of opaque entities currently listed on Western stock exchanges. The digital numbers on the screen are entirely programmable. If you do not intimately understand the mechanics of how corporate cash actually moves, you are simply the exit liquidity for insiders. To protect your portfolio from the next massive hallucination, hit subscribe, study the balance sheets, and never trust a digital ledger until you count the physical cups yourself.